With the end of the year fast approaching, it's the perfect time to focus on some key tax planning strategies that could save you money this year and also set you up for success next year and beyond. Hi, I'm Kurt, a certified financial planner, and today I'll walk you through a few practical steps to help make tax season a little less stressful and a lot more rewarding. Think of tax planning like tuning up your car before a long road trip. A little attention to detail now can save you from expensive headaches down the line. So let's dive into a few essentials that you can tackle before the end of the year. Tip number one, maximize your retirement contributions. So the easiest way to reduce your taxable income this year is by contributing to some of your retirement accounts. For instance, if you have a 401k, aim to max out your contributions because every dollar you put into your 401k lowers your taxable income. And for 2024, the limit's $23,000 that you could put in that account, with an additional $7,500 if you're over the age of 50. The second type of retirement account is an IRA. So you can contribute up to $7,000, $8,000 if you're over 50. And if you qualify, your traditional IRA contribution could also be tax deductible. And lastly, and this won't lower your taxable income, but don't forget about Roths. Now, if you're a joint tax filer, you can't contribute if you make over $230,000 in 2024. But if you do qualify, you can contribute $7,000 in 2024, $8,000 if you're over 50, and then that money grows tax-free for the rest of your life. So idea number one, maxing out your retirement accounts is a win-win. You're saving for the future while also reducing your tax burden today. Idea number two is tax loss harvesting. So let's talk about tax loss harvesting. Let's say you bought a stock at $100 and it goes down to 80. And you buy another stock and it goes at $100 and it goes up to 120. You can take that $20 gain and match it against that $20 loss, and those offset each other for the current year. And if you have additional losses, you can apply up to $3,000 of those losses to offset your regular income for the year. So remember, this strategy isn't just about minimizing taxes, it's also about right-sizing your portfolio for long-term growth. Idea number three, charitable giving. So review your strategy. So are you planning to make donations before the end of the year? Because charitable giving can reduce your taxable income if you itemize your deductions. And there's also a few strategies that you can think about to maximize your impact. One great one is a donor advised fund. So think of this as kind of like a charity savings account. You can make it a contribution, you immediately get a tax deduction, but you can still manage the investments and then decide later which charities that you want to support. It's a great option if you want to lock in your deductions this year, but you need more time to decide where your money will have the most impact. Next, let's think about clustering donations. So if your total deductions don't exceed the standard deduction, you could consider clustering multiple years worth of donations into 1 year. So for example, instead of donating $5,000 each year, you could donate $15,000 every 3 years, so you boost your deductions in that one single year. So the benefit is these strategies allow you to be more intentional with your giving and potentially could save you some money in taxes and amplify your contributions impact over time. Idea number four might be a little bit too late for this year, but something worth considering for next year, and that's check your tax withholdings. No one likes surprises at tax time. So now's a great time to check to see if your withholdings align with your income. So there's a free calculator on the IRS's website. You can use that to avoid owing a big chunk or getting a huge refund, which is basically just giving the government an interest-free loan. So small adjustments now, they can really prevent some big headaches and surprises later on. And lastly, flexible spending accounts and HSA contributions. If you have a flexible spending account through your employer, check your balance. Most FSAs have a use it or lose it rule, so go ahead and make that extra doctor's appointment, pick up that prescription, buy those extra glasses before the year end. And if you have a health savings account and HSA, you actually have until April 15th to contribute, but if you start planning for that now, it helps ensure you can max that out for the limit, which is $4,150 for individuals and $8,300 for families in 2024. So these are just a few year-end tax planning essentials to consider. Everyone's situation is different, so be sure to talk to your financial planner or tax professional to tailor these strategies to your needs. And if you found this helpful, hit the like button and subscribe for more tips to align your money and your meaning. And let me know in the comments what tax strategies you're focusing on this year. Thanks for watching. See you next time.